this trade is actually my favorite strategy. It's a basic strategy, but it works. And it doesn't have to be exotic. It doesn't have to be complex. It can be as simple as this put spread, and you can make consistent money. But the key is understanding what will not happen instead of what will happen. So this is going to give us at least a 95% chance of winning at expiration, because that's what probabilities of option trading is all about. It's about the time of expiration. So if you're selling at a 5 delta at expiration, you're going to have a 95% chance of winning because it's the inverse. In this video, we're going to talk about how to trade the bull put spread and make money. We're going to discuss 4 different points. We're going to discuss how to put the trade on, how to read the trade, how to adjust the trade, and take the trade off. We're going to go into it in as much detail as we can for this video. So you're going to might have to watch this video a few times to be able to get it down, but this is going to be an excellent way to make money consistently with the bull put spread, also known as the short put spread. It's selling a put spread, so you're receiving credit into your account. With that said, let me provide a little background about myself, and then we'll jump into the main part of this video. As for myself, my name is O'Brien, and I am the CEO of the Dorian Trader, which is an options mentoring firm that teaches individuals how to trade options on a one-on-one basis or in a group environment. I have ran a hedge fund, a volatility hedge fund, from a decade in the past, and options are my passion. I hope to be trading options for the remainder of my life, and if God willing, until I'm way into my hundreds. With that said, let's jump into how to trade the bull put spread and make money. So first of all, you have to think about how to put on the trade. So here at the Dorian Trader, we believe that trading the ES options on futures is the best way to be able to execute these bull put spreads, because we have the philosophy here at the Dorian Trader is what's not going to happen instead of what's going to happen. And we kind of learned this philosophy years ago from the book called The Complete Guide to Option Selling. We're going to throw that link into the description area. So if you're interested in learning about this book, introduces you to the options on futures and the mindset of what's not going to happen instead of what will happen. So most investors, they bet on, okay, I think XYZ is going up, and so I'm going to bet this. Well, here at the Dorian Trader, we teach members to consistently make money on betting on what will not happen. So it's a philosophy that it sounds subtle, but it's a huge difference in your mindset and your probabilities and winning every time you do a trade. So with that said, we're going to look at 67 days to expiration. This is the main expiration period of January. Normally here at the Dorian Trader, we consider this type of trade a bread and butter style trade, meaning that it's a 30 to 60 day time frame, and it's a strategy we call bread and butter because it's such a high probabilistic type of trade that can give you consistent income month after month after month. So in this example here, we're going to choose the 67 days. And what we normally do at the Dorian Trader is that we put this trade on no higher than a 15 delta, because delta determines your probability of success. But most of the time we put in this on no higher than a 5 delta because we want to be 10, 15, or even 20% or more away from at the money when we're doing these trades. So for example, if we go way over here and we go down to the 5 delta with 67 days to go, this is the last 5 delta. So this is going to give us at least a 95% chance of winning at expiration, because that's what probabilities of option trading is all about. Is about the time of expiration. So if you're selling at a 5 delta at expiration, you're going to have a 95% chance of winning because it's the inverse. So in this example, if we want to check and see how far we're away percentage-wise from at the money, we take the short strike that we are selling and we subtract it from the last price. And we're going to look at this last price here because this is what the futures contract is attached to. It's not attached to this. So if we take this price and we subtract it from here and then we divide it by there. So we're going to take the 51.50 minus the 60.96, and we're going to divide it by the 60.96, and that's going to give us 15.5% away. 15.5% away. So that is a significant distance from at the money at this point. And so what that means is that in Wall Street terminology, 10% away is considered a correction. 20% away is considered a bear market. So going down 10% happens almost every year, right? You can count on us having correction every year, but a bear market doesn't happen as often. So in this example, we are between a correction and a bear market. We're 15.5% away if we execute this trade. So the key of putting on these trades is understanding how far you're away from at the money, your probabilities, and how much you're receiving. So at the Dorian Trader, we have what we call a standard trade and a non-standard trade. So a standard trade meets all our criteria, and a non-standard trade obviously doesn't meet all the criteria. But it doesn't mean you can't do a non-standard trade. So in this example, we're going to see if it sets up as a standard or a non-standard. So we're going to do a 100-point wide spread here. So we're going to buy the 50-50. And so this is only giving us about $88 after fees and commissions for the ES. The ES, once again, is the options on futures, and it's $50 a point and not $100 a point like you would see with options on stock or the SPX, the SPY, something like that. But you're not going to be able to get a decent amount of premium, not even close to this, being as far away using the SPY or the SPX. So we're going to take this and we're going to look at it, and you can see that we're getting about $88 before fees and commissions divided by this buying power of 328. So that's a really good return on your capital, but it's not a great absolute dollar amount. But we're going to use this, and what we would normally do is do more contracts and things like that. So, but we're going to use this as an example. We're going to go over here and we're going to put in our bread and butter account, and we're going to send this trade and see if we can get filled. So we got filled right away, and this is the type of trade that we would put on consistently, and then we most likely would be in the trade for about 50% of the time. So if you put in it on with our typical time range of say 30 to 60 days, and if it was 60 days, you'd be out of the trade within 30 days, usually with a 50 to 75% profit. That's what we're looking for here at the Dorian Trader. If you want to learn more of the criteria, put it on this trade to make it a standard and what makes it non-standard, we encourage you to consider joining the Dorian Trader, join our trading club. We have a link in the description area that's going to give you a discount with the coupon code YouTube to join our monthly trading club. All right, so let's now talk about point number 2, and let's talk about reading the trade. So here at the Dorian Trader, we have zones. We have a green zone, yellow zone, and a red zone. And so obviously when we initiate most of our trades, we're initiating in the green zone, and then we adjust or make some type of decision once it goes into the red zone. So we initiated this trade here at the 5 delta, which is our green zone, and then if the market continues to, or the market starts to go against us, then we will it will go into the yellow zone, and then it will go into the red zone, and then we'll make some type of adjustment. Okay, and so that leads me to the third point, and that's adjusting. So we're basing our risk and reading the trade on this 51.50 strike, and then once it becomes in the red zone, we would do what we call an adjustment. And an adjustment that we would do here at the Dorian Trader is a roll up, a roll away, or a roll out. Normally it's going to be a roll away within the same expiration period, where we roll the tested side, the problem side of the trade, in this case obviously our put spread, because that's the only side we put on. We would roll it away from at the money to take it from a higher delta to a lower delta, and then we will add the opposite side to be able to pay for that roll away, from moving the tested side away from at the money. And when we do that, that will rebalance the trade, give us a little bit more time to be able to still win the trade. And that usually works, a high percentage of the time. But sometimes you're going to have to adjust again, or maybe even again. And then sometimes you might even have to roll out. And if rolling out is going to a different expiration period here at the Dorian Trader, and that's universal across what you will learn from others. So that's how we adjust. You'll learn how to do that at a super high level if you decide to join the Dorian Trader. So our our fourth step is taking off the trade. And so here at the Dorian Trader, we will sometime put on a good to cancel immediately once we put the trade on, and that will allow us to get out at 50 to 75%, depending on what that good to cancel what we set that good to cancel at. Sometimes we will get out of the trade based on a time frame. So if we put on a trade that's 30 to 60 days, in this case 67 days, and it gets close to what we call our 15-day rule, then we'll take the trade off and take whatever profit we have at that time. If we do not have a profit, then we will extend the duration of the trade by rolling it out to a later expiration. So that is how we kind of take this trade off. Sometimes you have to know some nuances about it, and we teach you that here at the Dorian Trader. But if you can learn these 4 steps of putting on this trade. So first, step 1, putting on the trade. Step 2, reading and understanding what's going on with the trade. Step 3, and that's adjusting the trade and knowing how to adjust it at a high level, understanding what we call the roll up, the roll away, and the roll out. And then just taking off the trade, understanding all the nuances about taking off the trade. If you can do that, you can trade this bull put spread at a very high level, right? And make money consistently. This is what we do at the Dorian Trader. This is why we call this our bread and butter strategy. This trade is actually my favorite strategy. It's a basic strategy, but it works. And it doesn't have to be exotic. It doesn't have to be complex. It can be as simple as this put spread, and you can make consistent money. But the key is understanding what will not happen instead of what will happen. So we're betting, okay, the odds on the S&P dropping 15.5% in the next 67 days is very, very small. And we're not going to be in it for the next 67 days. We're going to be in it most of the time, half of that time, and then all the time we're going to get out around that 15-day rule that you'll learn here at the Dorian Trader. So if you're interested in learning more, we encourage you to leave some comments in the comment area. We answer all comments. We encourage you to consider joining the Dorian Trader, our trading club. You can cancel at any time, but we want you to be a member forever. So we have to provide you value that represents being a member forever. So if you have any questions, once again, leave it in the comment area. Let us know what you think about this strategy and how we teach it here at the Dorian Trader. With that said, have a great rest of your day. We'll see you in the next video. Bye for now.